I think I talk loud enough, don't I? Not for you. So first on the agenda is roll call.
Teresa Taylor,
Here.
Dana Hollinger,
Excused.
Rob Fechner,
Good afternoon.
Frank Ruffino for Fiona Ma,
Present.
Lisa Middleton, Ralph Cobb for Irena Ortega, Mona Pasquil Rogers.
All right, thank you. Okay, so now we're going to move on to the election of the Performance Compensation and Talent Management Committee Vice Chair. First of all, I want to say that Dana Hollinger has put in her resignation. It is good as of or through June 30th. So this election will be for July 1st. The person will take place or take the position. And I would like to now put in and ask for a nomination for Vice President of Perf Compensation and Talent Management. And I'm sorry, Vice Chair. Did I say Vice President? Vice Chair. And I need you. Go ahead. No, please. I think.
Ms. Taylor, you can run elections for vice chair.
I can run elections?
For vice chair, yes.
Okay. Are you, who are you? So I'm very confused here, guys, because I have different names running through my head. I'm asking for a nomination for vice chair of the Perf and Comp Committee. And do I have a nomination for the vice chair? And it's Arena.
That's why we couldn't figure out. She's not.
Yeah. You're not on? Okay, hold on. I thought I clicked you.
Thank you, Madam Chair. I would like to place a nomination of Irena Ortega for Vice Chair of the Perf and Comp Committee.
Okay, I've received a nomination for Irena Ortega for vice chair of the Perf and Comp Committee. I've got a second. I've received any other nominations? Any other nominations? Any other nominations? All right, nominations are closed. I need a motion. Go ahead. I need a motion for the election of Irena for Perf and Comp. Come on. There you go.
I move that we elect Irena Ortega by acclamation.
It's been moved by Mr. Fechner, seconded by Ms. Pascal Rogers, and it's by acclamation, so motion is carried. Thank you. Sorry about that confusion, guys.
Tell her, Ralph.
Yeah, please let her know.
Ms. Taylor, you still need to take a vote, even by acclamation.
Oh, all those in favor of Ms. Ortega for the vice chair?
Aye.
All those opposed? All right, motion carries.
Can I proxy for her?
Can you proxy for her?
Poor girl.
She is here, though. Ralph is here.
But I'll do the same.
All right. I think we're done there. So let's move on to agenda item 3, approval of the June 18th, 2019 Performance Compensation Talent Management Committee timed agenda. What's the committee's?
Move approval.
Thank you. It's been moved by Mr. Fechner, seconded by Ms. Pascal Rogers. All those in favor of moving approval, say aye.
Aye.
All those opposed? Motion carries. And we are finally here. Executive report. Thank you, Mr. Hoffner.
Thank you, Madam Chair and members of the committee. We have three things before you today, two information items and one action item relating to incentive metrics, the 2019-2020 CEO performance plan for approval, as well as Grant Thornton, the board's independent consultant. We'll be talking about long-term incentives based on information that was requested from several months ago. This item is a first reading. I would make one recommendation because two of the items relate to incentive metrics. One's information, one's action. I would suggest we take item 8A out of order so we can hear the metric items themselves, some of which are contained in the CEO's performance plan. And if there are any modifications based on that feedback, then we'll incorporate it into that action item, if that's okay with you. And then I think we can move back to the long-term incentive as the final item for the day. That would be my recommendation.
Okay. Then we will do so.
With that concludes my report.
All right, great. So we have our action consent item. So I will, instead of 7, we're going to go to 8 after I do this, but I just wanted to make it clear. We're action consent items. I need to move approval for the performance compensation March 19th meeting minutes.
Move approval.
Moved by Mr. Fechner, seconded by Mr. Cobb. All those in favor, say aye. All those opposed, motion carries. Information consent items, I didn't have any requests to take anything off the information consent item calendar. So we're going to move on, and this is where you want me to move to 8, right?
Yeah, I think item 8A would be the first one, then we go to 7A, and then 8B to close out today's session.
All right, let's move on to 8A, and that is Grant Thornton, I think, right?
Great. So, Eric Gonzaga, and glad to be here to discuss the annual incentive plan metrics again. First and foremost, what you have in front of you is just the same consistent performance metrics that that have been in place and recommended since we started the work back in 2016. And the whole intention of these metrics was to come up with a balanced scorecard with which to evaluate CalPERS performance. And when I say balanced scorecard, it was intended to cover all organizational metrics, to the extent that what we're really focusing in on is global performance for the organization. And those metric categories specifically are 1, total fund performance. So management of the funds to ensure there's appropriate benefit. Enterprise operational effectiveness, which that's intended to ensure that the organization is operating efficiently, whether it's as an organization overall or relative to the investment office. And customer service and stakeholder engagement. So those are the metrics that you have in front of you. Now, going back a few years, because it very much sets the baseline for the recommended categories and the recommended performance levels that are included in this document. What we did when these were put in place is just study 2, 3, 4-year performance levels of the organization and tried to come up with metrics that would pay out at threshold for good performance, target for very good performance, and maximum levels for outstanding performance levels. And a lot of this was based on historical performance, including and trying to stretch the organization accordingly. And I think these are, in some respects, considered best practice performance metrics. So when you take a look at the proposed performance metric for total fund performance, it ranges, and it's based on relative performance. You pay out at target for beating the benchmark by, 5 basis points, maximum for beating the benchmark by 35 basis points, and you have to be comparable to the benchmark before there's any payout accordingly. So that's metric number 1. Metric number 2, in terms of overhead enterprise operational effectiveness, there's 2 metrics. One is for the overall organization, which measures the performance in terms of overhead operating costs as a percent of overall expenses, overall budget. And again, these metrics are based on historical performance ranging from, they'll pay out at maximum if we reduce the ratio by 1.1% to paying out at target only to the extent that we're somewhere between 1 to 1.5% of prior year. Investment office, CEM, that's another way of demonstrating operational effectiveness. And that's the investment office taking a look at both costs and returns, paying out in a cascading impact to the extent that you're both beating and exceeding both cost and returns. So it's the efficiency of the returns that you're generating. Same metric as used historically. The next metric that's used, and again, it's customer service. So how are we reacting to the needs of the members, and how are we delivering service? We have a combination metric related specifically to the survey scores, with one element linked to benefit payment timeliness, so an indicator of the service that we're providing, in customer satisfaction. And again, these levels haven't changed over last year. We considered them to be stretch performance last year. We consider them to be good goals this year. And then the final metric is stakeholder engagement, which is, okay, we're a mission-driven organization. How engaged are we with our members? And it's based on, survey scores related to the needs. Is CalPERS designated? There's a survey filled out. Are we responsive and sensitive to the needs of stakeholders? Do we good job of keeping our members informed? And how good are we at engaging and communicating? And what we've done this year, so there is a bit of a change, because we know this is an organization that wants to continue to stretch its performance, its deemed performance and continuous performance improvement. The scores have went up by percentage point to continue that evolution in terms of stretching performance, in terms of how we're meeting and engaging with the needs of stakeholders. So those are the performance metrics in a nutshell. We believe that they're very solid metrics, symbolic of the overall mission of the organization. Returns are important. It's a portion of it. But in addition, we're talking about measuring the performance of the overall organization, and the executive team has line of sight where there's shared accountability relative to these organizational metrics. So that is it in a nutshell.
Thank you. Oh, Ms. Campbell.
Tina Campbell, CalPERS team. Just one point of clarification. This is a first reading item, but it is at the discretion of the committee. If you either don't have questions or changes, you can approve this as is today if you choose to do so.
Okay, I appreciate that. I'm not sure what I did have a couple of questions. I know we've been working on this for a long time, Eric, so I don't want to say, oh my God, I just saw this. But I'm looking at the customer service score. So are we saying the customer service score is if we answer and or pay benefits at equal to or above 95% of our, then that's where we get to 150. And to get to 100% of your bonus, it's 92 to 94%. I thought that seems new, but maybe I'm just...
No, that's correct. That's correct. It's within those established performance levels, and a lot of it was driven by the fact that, I think there's been a new survey methodology adopted over the last few years, but it was starting from the standpoint of taking a look at historical performance. And I don't know if you haven't ever achieved, 95%, and it started with setting the baseline for exceeding historical performance levels. So.
Okay, and the historical performance levels, are our historical performance levels, and we're not comparing it to any other phone service area, are we, Ms. Campbell? I'm not sure.
In this case, this is Doug Hoffner, the CalPERS team member. In this case, we're not. This is basically looking back at our historical performance. We also report this out in the enterprise performance reporting on a quarterly basis to the board, so you can actually see then quarter by quarter where we're trending. Are we above that threshold or not? So this is really trying to connect the incentive as it relates to actual our performance. And so you can see that on a quarterly basis. I don't have the most current one in front of me, but we'll report that out after the current fiscal year is over. But you would then see how we've trended historically over time, over years. and to where we're going to be looking at what is the impact at this point to this metric, which is
Okay.
consistent with what we had the last 2 years.
Okay, and that's what I was just trying to figure out. I couldn't remember if we had compared it to anything other than our own history. Okay. I see no other questions. I would like to move back to 7A then.
Good afternoon, Madam Chair and members of the committee. Tina Campbell, CalPERS team member. Agenda item 7A is an action item which seeks approval for an incentive plan for the Chief Executive Officer for fiscal year 2019-20. The board's compensation policy for executive and investment management positions requires the annual approval of an incentive plan for the CEO. The proposed plan maintains the priorities and metrics from the CEO's fiscal year 2018-19 incentive plan. Any changes made to the incentive metrics that we just spoke of will be incorporated into the incentive plan for the CEO. The committee may approve the plan as presented, or if you have any questions, I'm happy to take them.
So, Ms. Campbell and Mr. Hoffner, I was wondering if we could possibly, since this is a first reading, and I'm not sure that we're ready to move on the first reading of the actual long-term incentive plan from 8A, or the metrics. I think these are tied together. Are we, Mr. Hoffner, did you
So
want to
actually,
address that?
they're not. These two are tied. So this item relating to the CEO's 2019-2020 performance plan is tied to the metrics that Mr. Gonzaga just spoke of, which are the same metrics we've had in place the last 2 years. This would be the third year of that plan. This item includes additional leadership metrics based upon the conversations on these 5 categories up front that you discussed with the CEO 2 years ago when she started.
Right.
The long-term piece is not included in these two portions of these two items. The long-term incentive is actually not
part of
as
it now.
designed today to be included in the CEO's performance plan as presented in the next item later on today. So they are separate. We wanted to identify that the information item that you just spoke of is embedded, half of it's embedded here in the CEO's plan as well, in addition to the leadership metrics. They're additive to the overall plan, and that's what we're trying to convey. So if you approve one or you don't approve one, you modify the 7A item, you'd want to make a corresponding change to this item. But this does not talk to the long-term incentive at all.
Okay, so if we adopt, because I believe Ms. Campbell said earlier that if we want to move to adopt 8A rather than just an information item, we can do so, which would then also allow us to adopt 7A. Is that correct?
That is correct.
Okay. Do I have any appetite for doing that? Does anybody want to speak on that? I'm going to go ahead and give direction from the committee chair then to go ahead and vote on 8A as an action item. I need to move a motion to have 8A as an action item to be approved. I need a second. So moved by Ms. Middleton and seconded by Ms. Pascal Rogers to have 8A as an action item. All those in favor of the annual review 2019-20 incentive metrics being passed as an action item, say aye. Aye. All those opposed? Motion carries. All right, and we were on 7A. And did we want to continue? Go ahead. On the CEOs, I don't know if you had finished or not.
Yeah. So it was basically any discussion that you had, and I heard a little bit of discussion, and this is an action item, so if you are okay with the way that it is written, then you can approve that as well, the action item.
Do I have any comment or anything on this item? All right, seeing none,
I'll move the item.
I need a motion. Thank you. Mr. Fechner has moved the item. I need a second. Ms. Middleton has seconded agenda item 7A, the 1920 incentive plan of the Chief Executive Officer. All those in favor say aye. All those opposed? Motion carries 7A. Thanks. And, sorry. Mr. Darby, come up here to our right. I thought you were further down.
Madam Chair, committee members, Al Darby, President, Retired Public Employees Association. The specific part of this plan that I'm speaking to is the investment office. And since this is all part of the same motion, I believe, is it not?
This is 7A that we're talking on, yeah.
I guess what's the specific question? So the total fund provisions, or which?
Well, okay. Are you going to shut off my time because?
Can we start it over, guys?
The 7A includes not only the CEO plan, but also the investment office, enterprise operational effectiveness, and so. Correct. Yeah.
Right.
All right.
That's all the CEOs.
All right. Specific to the investment incentive plan, RPA believes that the investment performance bonus plan as presented here is not aligned with the interests of members and beneficiaries. It appears to lack risk-adjusted safeguards and thereby serves the interests of the investment officers eligible for the performance bonus. A plan that encourages and/or permits adding risk to the portfolio without appropriate risk adjustment safeguards is not in the best interest of members. In addition, a system such as this that allows bonus payments for underperformance is also a disservice to members. Bonuses should be paid upon achieving the benchmark for risk-adjusted return on investment. This should be the only incentive pay criterion. RPEA recommends you amend this motion to reflect the conditions that we've mentioned here. Thank you.
Thank you, Mr. Darby. All right. Mr. Hoffner, can we move on to 8B? I think that might help Mr. Darby, long-term incentive program design. And that's Ms. Campbell. I lied.
Tina Campbell, CalPERS team member. Agenda Item 8B is an information item and first reading for long-term incentive program, LTIP, design. The board's primary executive compensation consultant, Eric Gonzaga and Eric Mishka from Grant Thornton, are here to present the recommendations for your review. This item is being presented as a follow-up to the February 2019 Performance Compensation and Talent Management Committee meeting when the board approved a revised compensation structure for investment management positions. The approved structure included revised base salary and incentive ranges, as well as long-term incentive component. When the structure was approved, the committee requested the consultant return with design details regarding the long-term incentive component, which they will do today. We'll return for a second reading in August 2019, along with applicable changes to the board's compensation policy for executive and investment management positions. Unless the committee has any questions at this time, I will now turn it over to Mr. Gonzaga and Mr. Mishka.
All right, Mr. Gonzaga, go ahead.
Great, thank you. So, and certainly I think that this will blend in nicely with the public comment that was just recently raised. What we're talking about here today is this? This must not be on. Oh. So what we're talking about here today, ultimately, when we were engaged, and this goes back a good 3 years now, when we were engaged to take a look at the incentive strategy. And part of it is certainly reflective of the need to retain the right types of professionals. Secondarily, the issue is, okay, let's come up with a pay plan that reflects the mission of the organization, and certainly a big portion of that is sufficiency of funding and investment funding related to the pension obligations. Initially, we started out, modifying the annual incentive plan, so it looks like where we're at right now, certainly taking into account, performance, relative investment performance, which, addresses risk to a certain extent. The second component that we talked about right from the get-go was, okay, if what we're trying to do is balance the incentives of the organization focused on both the long-term nature of the mission of the organization. Doesn't it make sense to also have a long-term incentive plan such that there's this balance between annual performance in addition to sustained long-term performance? And ultimately, that's how we ended up at this long-term incentive design structure. And so in this instance, what we'll walk through, I'm just going to walk through the basics, and then I'll hand it over to Eric to walk through the technical details. But the things to remember first are just some definitional items as we go through this. One is that the metric revolves around CAGR, so that's compounded annual growth rate. That's intended to make sure that there's a lot of blips that go on from one year to the next, but it's intended to measure sustained performance for that 5-year period. How good are actual returns as opposed to just simply average returns. And the whole point is to have performance tied to sustained 5-year performance, which complements the nature of the annual incentive plan, which is short-term and periodic in nature. Second is, at least to start out, we recognize at this point that, the expected return is approximately 7%. That's what you use for all the actuarial funding. And so right now, we model this out assuming target should be that 7%, because that's what the organization is expecting. That's the expected rate of return. Initial long-term incentive plan values. There's a relationship here between the annual incentive plan and the long-term incentive plan, which is to say that the initial long-term incentive plan, it's going to be funded from the standpoint of it's going to be the lower of the target values under the annual incentive plan, or the most recent historic payout under the annual incentive plan. That's what's going to go into, that equivalent amount is what's going to go into the long-term incentive plan. So what that says is, okay, if you achieve certain relative performance criteria, that's the amount that is going to go into the long-term incentive plan. And aside from, so we measure relative performance through the annual incentive plan, and then consistent with alignment of the pension holders, it's simply that that amount will go up or down based on the absolute return to the organization. In other words, unless you meet certain criteria and the funding isn't improved, there aren't appropriate returns, the long-term incentive plan payout goes away altogether. Additionally, we're capping the amount at 150% of whatever goes into the long-term incentive plan, so we're not encouraging too much risk-taking. But the intention is to come up with a balanced scorecard, again, measuring relative through the annual incentive plan, absolute on the long-term incentive plan side of the house, and coming up with certain threshold and maximum criteria such that we're not encouraging too much risk by either paying out too much or paying out too little, for the most part. And, the performance period is going to be for a 5-year performance period. We're recommending that it's actually longer than what you find in many industry organizations where it tends to be measured over a 3-year performance period. The point there is, again, we recognize that we do want returns, but we're also recognizing that it needs to be sustained over a long-term period, hence the longer performance period than normal. And, finally, this is all going to be based on total fund returns. We're talking about managing performance. How much are we returning from an appreciation standpoint with the overall fund itself? So, with that, that's the baseline. I will hand it over to Eric to walk us through the technical detail.
All right, thanks. Good afternoon, everybody. So just to recap real briefly, I know Ms. Campbell mentioned this prior, but in the February meeting, the committee then, agreed to increase salary midpoints to 50th and 75th percentile, and adjusting consolidated the annual incentive ranges for the investment office, and then also introduced this long-term incentive program concept. Kind of our overview of recommendations, measure total fund return over 5 years, and we'll go through each of these items in a little bit more detail on what this means. Target goal performance for the entire period, with the goal being the expected rate of return in the first year. The initial LTIP award going to be that the lesser of actual performance actual bonus payout as well as the target award for that year. And then that amount will adjust to 0 to 150% depending on performance. So when we talk about performance levels, the target performance being that expected rate of return in year one based on the actuarial assumptions of 7%. Having a guideline of performance that's kind of a threshold performance up to a maximum performance of about 80 to 120% of target is what we recommend. This gives a little bit of room for maybe performance that wasn't quite up to target, but still provides a payout and also mitigates any potential excessive risk taking to get to a target payout of 100%, which 80% of 7% would be 5.6%, would be that threshold performance over that 5-year period on a compounded annual growth rate. Maximum performance being up to 8.4%, which reflects 120% of 7. Again, anything that kind of falls in between that would be interpolated. So if there was a performance that fell between 5.6 and 7%, the payout would be adjusted accordingly. We'll get into how these relate to payouts in a second, but if there's any questions on the total fund return performance metric.
I have no, oh wait, I do have a question. I have 2 questions. Ms. Pascal Rogers.
Thank you for the report. I just have I'm not sure if this is a ridiculous question, but so I get the 5 years, but you mentioned the industry usually does about 3 years. So do we, does that negatively impact us in terms of getting good people by saying, everybody else or on average does it 3 years, but we're going to go 5 years? I just don't.
No, that's a great question. And, my thought would be that we made, and that is the one perspective, is that when we did the analysis going back a few months back, there's a total pie that we're talking about here. And so long as, salaries and annual incentives are competitive, the fact that you're extending performance over 5 years as opposed to 3 years, it should not make a difference if the rest of the compensation program is fair. Now, what I will say is that the market, there's this whole concept of long-term incentives and long-term performance plans. They just kind of fell on it being 3 years as the market practice, and there's no reason other than it seems a little bit easier to manage instead of 5 or 7 years, recognizing that 3 years isn't necessarily a perfect long-term performance period. I think with the mission of the organization, it's good because a couple things. We're talking about grants that are going to overlap. You'll get a grant every year. And so at some point after that 5-year period, you'll have an opportunity for a payout every year. It's just those intervening first couple of years where there may be some issues. But I don't think it should reduce the ability to recruit and retain. And the other thing is that if anybody should have a longer-term performance horizon, it's an organization like CalPERS, which really does have a 100-year mission and sustained liabilities that are going to go on for a number of years. It's not a short-term play like you find with for-profit asset managers. So.
And the one thing, too, we are seeing some larger financial institutions considering or moving towards at least a 5-year element to their plan, just because 3-year might be the average now. That might have changed in the future.
So, and I'll say, Ms. Pascal Rogers, when we did this a couple of years ago, we were thinking long-term because we are such a long-term investor, and I think that's why we picked the 5 years for the same reasons. So, and then Mr. Cobb.
Thank you, Madam Chair. We remain concerned because of the lack of analysis and the magnitude of the pay increases that this facilitates. CalHR was just criticized in the media for giving a 3% rate increase to public safety workers that put their lives on the line. And this, the long-term incentive just adds to the, another order of magnitude to the pay to some of the most highly compensated state employees of all. But with that, looking at the threshold performance, the 5.6% total fund return, that's the minimum threshold for triggering a payout under the proposed plan. what is the magnitude of a 5.6% rate of return over 5 years? What does that look like in terms of funding level for the fund? And I think that needs to be presented so that we can see, is that something that we're comfortable paying an incentive bonus for?
That's a perfect question, Mr. Cobb, because that brought Mr. Junkin right up, and I was going to ask him, number one, I wanted to sort of address Mr. Darby's, our CAGR calculations that we use also includes risk adjustment. So when we do that, it is risk adjusted. But also, could you address what Mr. Cobb was talking about, what that would mean? Because I also had a question on that. Who wants to go first?
I think we should let Mr. Tarando from the actual office.
There you go.
He's done some analysis, so I think. And then
that would be great. That would be
Mr.
great.
Junkin
What
wants to
would
weigh in on
happen
that as well.
if we got a 5.6% return for 5 years?
Good afternoon, Scott Tarando, Chief Actuary. We looked at what would happen if we got a 5.6 return for 5 years, starting with the approximately $366 billion fund we have today. And then we looked at this in terms of loss and additional contributions this would generate. Over the 5 years, we estimate approximately a $29 billion loss, and then additional contributions approaching $59 billion in additional contributions for the entire fund. It would also probably result in about a 5% decrease in the funded status.
Wow. So basically, this minimum threshold, what you're telling me, is this minimum threshold shouldn't be getting even 50% of a payout, based on the fact that we would be.
Well,
I mean, that's what my assumption is.
It's not for me to comment. I just.
You're not telling me anything. I get it, Scott.
Ms. Taylor, I would ask either Grant Thornton or Mr. Junkin to talk about industry and why the recommendation is coming from your independent consultants on these numbers. I would ask to go into a little bit more background and analysis of where these numbers are coming from.
So if you want to address that.
Yeah, I'll just start out with, the whole purpose for, recommending, where we started out was with the total fund returns at 7% paying out at target, because that's, what's stated. The 5.6 and the 8.4 is nothing more than an industry standard in terms of, plans tend to pay out based on good performance at threshold, outstanding performance at maximum. And so this was just really, and it tends to be in that 80 to 120% performance dichotomy. Now, and I recognize, certainly the loss of, although returns are positive, it's just because you're planning on a 7% return that would result in some deficits because of how the pension's funded. Our recommendation isn't, and that 5.6%, we can always work around that, but the issue is just making sure there's an appropriate spread between threshold to target to maximum. And the whole point is we recognize that performance in any given year isn't an exact science, and what we're trying to do is create an array of performance criteria that pay out at variable levels. It also, encourages, it helps to ensure no excessive risk taking as opposed to just picking one specific number. If it's just 7% and we're at, 6.4%, don't we want to continue to encourage continued performance improvement trying to get to that 7% as opposed to putting an absolute minimum performance threshold at 7%, which in some years, given the change in circumstances, may actually be great performance, better than good target performance.
So I will say, for me, and I know we've looked at this before, but I think that the numbers we're looking at, I think the threshold, based on being underfunded, okay, we're 70% funded. We can't afford to be paying bonuses when somebody hits 5.6, or when we hit a total overall fund of 5.6%. I'm wondering if we want to make the 7% the threshold performance, and I'm going to ask Mr. Junkin to comment on what he thinks about, just in general, what Grant Thornton's come up with, and then create a middle between that target and the 8.4% maybe. But in any event, Mr. Junkin, could you comment?
Gladly. So Andrew Junkin with Wilshire Consulting. I just want to touch back on the compound annual growth rate. That's how all returns are ever presented to you when you're wearing your investment committee hats. That's the standard across the investment industry. It does not have an explicit risk adjustment in the same way that a Sharpe ratio might, but as Mr. Jones pointed out yesterday, compound returns do account for large drawdowns in that if you lose 50% and then you gain 50%, you're not even, right? You're still down 25%.
Right.
So that's still reflected in the way compound returns are calculated. But we would never show you a return that wasn't a compound return. So that's just industry standard. And Scott got to the shortcut that I was going to come up with, which is if you're 1.5% behind your actuarial rate for 5 years, it's not perfect because you have to account for the size of the liabilities and the size of the assets, but you can pretty quickly do the math on you're not making actuarial progress, you're losing ground.
Right.
One of the concerns that I actually take notes in my iPad, and I still have my notes from when we talked about this in February, and one of the things that I talked about was having a long-term incentive plan payout based on absolute return is really something that staff is going to have zero control over, right? So it'll get funded by excess return, and so if they do a good job of beating the benchmark over 5 years, even if the benchmark is down, there would be an allocation to the long-term incentive plan. But if you have a year in the subsequent 5 years, like 2008,
right,
you're never going to get to 7% with years that follow. With a 4 good years are probably still not going to get you to plus
7%.
So quite honestly, I struggled with that, and I struggled with it for the same reason that you did. And one of the points of view that I sort of came around to in the corporate world, in some ways this is analogous to me to a stock option plan. And so if you're a participant in the plan, you're granted options on the corporate stock that have a strike price. And if the stock goes up, you can exercise and profit from that. If the stock goes down, you make zero.
Right.
If it's below the strike price. And so really what you're incentivizing people on is generally corporate health and welfare, and that the stock goes up. Now, you could still have a 2008 that would push an individual stock down, and there'd be no payout in that stock option plan there as well. Where you set the numbers gets a little bit challenging. As you'll recall, the 7% actuarial return is basically your forever return, right? It's the return that I think Scott assumes you're going to make from now until the last benefit payment is made for the current population. But you don't really want to have a long-term incentive plan that's that long-term. Probably too much for any individual employee. The expected return, but that is the expected return with some, I think, margin for adverse deviation. The expected return over the next 10 years is actually below 7%. And if you think back to the CEPPT presentation that we did yesterday,
earlier,
you saw some of those numbers. But I think the expected return on the PERF over the next 10 years is something like 6.25%. And Scott's welcome to correct me on that. And that would be great. And then we expect the next 40 years following that, so years 11 through 50, basically, to be higher than 7% by a large enough margin that it drags up the overall return to 7%. So all of that is to say, I don't know if 7% is the right number or 5.25% 6.6 or 6.25. But I think if you think about this as the overall health of the organization, I mean, there's really the investment committee. I'm used to addressing the investment committee, so I have to change my thinking. The investment committee sets the strategic policy, and that drives the expected returns. And if there's a great market in equities or a really poor market in equities, staff doesn't have enough levers to be able to move out of the way or into the way of that, as the case may be, to really, let's say, the policy returns of the, call it 50% growth and 30% income, and however I don't have the numbers quite in my head programmed at the moment, but if that turns out to be 5%, they can't make the returns of the portfolio be 8%.
Right.
They just don't have enough tools in their toolbox. So this is one of my concerns about using total fund returns. The only way I can make it make sense in my head is thinking about it as the overall health of the organization, like that stock option plan that I talked about. So,
what would you suggest for that then? Overall health of the organization?
Well, I think actuarial progress is the right way to go. So I think you've asked the right question.
See, I think if we were fully funded, we could do this, right? We could do the 5.6 and not have to worry about it, or the 6. I'm aware that we're targeting 6.1 or 6.25 for the next 10 years, and that's where we might be, and that means that nobody gets a payout. But we are underfunded. If we had 95% funding, I'd have no problem with this. But I don't disagree with Mr. Cobb on the fact that we can't afford. I mean, I don't know. What about making the target, the 10-year target, as part of it?
As the threshold?
Yeah.
I think you'd still lose ground actuarially.
Right.
Looking down at Scott for confirmation, if you made 6.25.
We would still lose ground, right, if we went for the 10-year target. Yeah. I'm seeing nods. And then we'd have to reset.
There's a couple of challenges. I mean, right now, where the valuations are based on the flat 7%. So if we don't get 7%, it's going to fall behind.
Right.
And basically the result will be we will increase contributions to make up for that loss. That's just how it works actuarially. If there's a gain, excess returns, we factor that in, and that the excess is used to reduce contributions. So there's kind of like
it's a back and forth.
So it's a back and forth. The one challenge I see with using a 10-year return is, remember, we have a 10-year return. Next year, we're going to have a new 10-year return.
Right.
We have a 10-year return.
Well, yeah, because 2008 fell off, didn't it?
So it's going to be constantly moving. So at what point where do you put your end point?
Right.
Because, right now, the return for the 10 years is like 6.1, 6.2. 5 years from now, you're going to have a different 10-year return.
Right.
And so how do you would have a moving target if you use a 10-year return? That would be just another challenge that you're going to have to deal with if you look at it from that point of view.
Okay, I'm going to let everybody else wrap their brain around this, and I'm going to start with Lynn. Thank you. Oops, wait, I didn't get you. There you go.
Thank you. Mr. Gonzaga, can you remind me what portion of the total compensation would the long-term incentive program be?
It would depend on position, but it would essentially be equal to, the intention is for it to be of equal value to the annual incentive plan, which would require, because as we went through the process, I mean, you could take a look at that right there, where it's intended to match up to be equivalent to what the annual incentive opportunities are. And the whole thinking behind that is just to always have this push-pull in terms of motivating annual performance versus the long term.
And plus the retention component of staff.
Absolutely.
Okay, and for that reason, I think 5 years probably makes more sense than 10 for the retention. But I agree with you, Teresa. I think it would be very difficult to be in a situation where the fund is raising contribution rates again and lowering the discount rate, and the funding status is going down, and then be paying out 5-year incentive bonuses. And I know that the first year, even if it was approved now, the first incentive payment wouldn't be paid out potentially until 5 years from now. But couldn't you be in a situation where you have double-digit returns for the first 2 years of the 5-year period, and then you've got negative returns and you still owe the 5-year bonus payment? I think that would be hard to do.
No, that makes sense. And I will say one thing before somebody got off. Okay. One of the things that I think we, as average folks, when the Wall Street crash happened and people were still getting paid their huge bonuses, crash may have not been through the fault of the CEO of Google, but their returns went down too. So their shareholders were taking a loss. So I think it's important that we look at it as, these are our members, and if our employers have to put in more money, and I see a problem where 5.6% is just too low. I've got one more person, Ms. Middleton.
Okay. Thank you, Madam Chair. I have some competing opinions, but I was struck by Mr. Cobb's comments, and I know if we are in a situation where we've lost value and we're going to municipalities and counties and telling them that the discount rate's not going to be 7% anymore, it's going to be something less than that, they're not going to be looking to reward anyone. What they will be looking for is heads to do something with that's not really very nice. That said, though, we had yesterday a very good conversation with our Chief Investment Officer, almost all of it devoted to conversation around how to manage the potential for a drawdown. And if we are in a situation where the market has turned substantially to the adverse, what I want to be rewarding is an investment officer and leadership that weathers that storm and does so more successfully than the competition that they are in, that truly demonstrates leadership at a time. So I don't want to create incentive programs that leave us in a position where we have folks, instead of preparing for the worst or trying to maximize their benefits at a time that they potentially can. So one fallback, it seems to me, we have is we can come back each year and make adjustments to these plans as we need to make adjustments based on what's happening in the real world. And if we wake up 12 months from now and we are in a substantial economic downturn, we may well be finding that something less than 7% is viable. I pray we are not there.
I agree.
Yeah, and I would just, that's a great point, Ms. Middleton. And what I would say is that there's this discussion around, picking the 7% versus the 6.25%. And what I will say is that this plan, like all performance plans, is intended to be flexible. And what we would say is that, let's say the target is 7% for that first 5-year cycle. Second year comes around, there's going to be another 5-year cycle there. And you may well say, okay, well, the market's moving at 8%, or we should be at, it slowed down a little bit, 6.25% is the right number. There is a lot of flexibility around that for the committee and the executive team to debate what's realistic. And so these performance metrics, could potentially be modified. Maybe not every year, but every other year. There's a discussion about what the long-term projections are. So it forces a discussion around what the right expected returns are.
Well, I will say before I call you Mr. Junkin that don't forget, everybody, that we are doing an annual incentive as well. So let's bear that in mind. This is a long-term incentive that we're discussing at this point, Mr. Junkin.
I just wanted to hit on the point that Ms. Middleton made. Having been here during 2008, and it being an entirely different incentive plan at the time, certain asset classes earned their incentives in a down market, and there was a significant amount of public pressure on the board about paying those bonuses. I would argue there's a lot of economic value added in outperforming in a down market. I mean, as much as there is in outperforming in an up market, mathematically it might be more in a down market, but a percent of outperformance in a down market to me is still worthy of a bonus. But I watched this body struggle with the pressure from the SAC-B and others during that period of time, and it was intense.
And I will say that we weren't, I mean, people were not just looking at CalPERS, they were looking at Wall Street, the fact that bonuses were still being paid. And I get what Ms. Middleton is saying, that if we're outperforming and doing what Mr. Mang is saying that we should be doing, which is, you know, really looking for those opportunities to make great investments and being successful at it, I think that's a really good thing. And yes, that probably does deserve a bonus, but maybe that can be something we look at down the road. I would certainly not, I was not here. I know that Mr. Fechner was here, but I would certainly not want to be sitting up here with that conversation right now.
Maybe can just follow up real quick. So Mr. Ming wasn't able to be here for this session, but he's had an opportunity at the July offsite to talk about the workforce plan that he's going to be bringing and presenting to you in terms of additional feedback. So between a first and second reading, we'll have that other meeting. I think a little more information available to all of you and the full board in terms of sort of that future planning that I think Ms. Middleton is talking about. So
Great. And I don't have any other questions on that. Oh, yes, I do. Boy, you guys are quick,
Ms. Taylor,
man.
could I make one comment?
Sure.
It really goes back to, the whole purpose of, why we recommended the structure that we had. Relative returns are ultimately the funding vehicle for what goes into the long-term incentive plan. So unless you're beating the benchmark, there won't be anything that goes into the long-term incentive plan. And that was by intent, just to specifically, always have a decent incentive out there for whether it's beating in a down market or making sure you're if everybody's going by 15, 20% up, you still have to beat the benchmark. So there is nothing that goes into the annual incentive, the long-term incentive plan without good relative performance. The other thing is that absolute returns, why that becomes important is specifically to address that whole issue. I know that there's a lot of public sensitivity out here, and it's to say that, you know what, if we're not growing by X amount, there won't be any bonus paid. If returns are negative under this absolute component, there would not be any part paid out under the long-term incentive plan. There may be as part of the annual incentive plan, but not as part of the long-term incentive plan. Okay?
Great. Mr. Miller, go ahead.
Yeah. Those of you who have spoken with me about this whole subject know that I'm something of a contrarian on this in particular, in that I kind of view this, I think the linkage, causality of performance and incentive pay is very tenuous. But I view it as critical to being able to attract the kind of talent we need to attract. And to do that, we have to attract and retain people through good times and bad. Even if you're having a losing season, you still need a dynamite starting pitcher. You still need to keep your talent. And so when I look at this, I think of it often more in terms of the symbolism, the alignment of our communication, our priorities, the ability for our CEO and the rest of the executive team to send a message about what's important to us, what's important to our stakeholders. It's symbolism, it's messaging, it's all that. To me, that's a much more convincing reason to do this stuff, because of what is something being a standard practice in the industry. I don't always agree it's necessarily because that truly drives a person's ability to perform or make a decision. The fact that it reinforces our priorities and expectations on behavior, that's the importance of it to me. And to some extent, it's message, it's pageantry, it's ritual, but the fact that it has value in people's minds, especially the kind of people we want to recruit and retain, and the value it provides to the organization. I have some of the same arguments about some of the fallacies of some of the root assumptions we make with strategic planning as well. But no matter what we do, we're going to get the market. If there's a drawdown, we're going to get beat up. We're going to get beat up by the B. We're going to get beat up by the right. We're going to get beat up by the left. If just even paying people at all, if they're not, So I think we need to really focus on what do we need to do to support the organization? What do we need to do to support our executive team and their ability to get and keep the talent that they need as Ben works on his plan going forward and the workforce elements of it. And so that's what I would suggest we try to keep forefront of our mind versus really looking at assuming that these differences are going to actually drive someone's performance, make them any smarter, make them change any given decision that they're going to make on any given day, because whether you paid this much or this much, that's not what changes it. It's the message it sends about our priorities and how we manage the organization, not I'm going to be that much better at making a portfolio decision if I'm paid X amount more.
Thank you.
Yeah, I think that Mr. Miller makes a lot of good points. And in my perspective, as a compensation professional, is just simply that, look, you're going to have to pay what you have to pay to recruit and retain the type of people that you want in. Incentives, they do not make okay performers great performers. What you're talking about here is your ability to hire the right people. And we've taken a look at the numbers. This is all built around paying as competitive as you can. And it certainly isn't going to be competitive with industry. There's still going to be a significant discount coming to CalPERS, but it's paying competitive enough to optimize your recruitment retention for certain people. Now, if we can agree that you have to pay whatever you have to pay to get people in the door, the second issue comes down to, what's the value of the pay plan in general? And it is, compensation is about nothing more. If we assume that you have to pay what it takes to get talent in the door, incentives are about communication, and they're about alignment, and it's about culture. They will not make a good performer a great performer, but they will help rally, because it doesn't matter if it's a for-profit organization or if it's CalPERS or a tax exempt. The reason incentives are used is to get the board and the executive team on the same page in terms of communication about what's most important for that given year or that specific performance period.
So, Mr. Cobb?
Thank you, Madam Chair. Something that we were touching on earlier about that that these can be changeable. How is this going to work if we're 2 years into a cycle and there is a need to change the discount rate, and all of a sudden, 7% isn't 7% anymore, it's some other number, higher or lower?
Yeah, so for the first year, we'll say, so let's use 70% as the example. That would be the target compound annual growth rate for that 5-year period moving forward. And then the next year, let's say you have a discount, and maybe now the target's 6.5%. That would set the target for that next 5-year period. So we wouldn't retroactively adjust the current period that's, midway through, but it'll just be prospective moving forward for that performance period.
Because we don't necessarily, we don't change the discount rate all that often, but when we need to change it, we need to change it regardless of whether it fits into some artificial 5-year cycle. So you'll need to build something into the policy that, that accommodates that, because when there is a need to change the discount rate, that need is compelling and can't be driven by extraneous factors. And then I just wanted to validate my understanding. There's a lot of material here, and I didn't see anything in there where there was some kind of discretionary element to award compensation when a target wasn't met. I think there is in like the base pay area. I just wanted to validate there's no discretion in here where the CIO or the CEO could award a long-term incentive when a target wasn't met.
And the answer is yes. I mean, there certainly is discretion to take away awards if an individual doesn't meets performance evaluation during the performance
I saw
period.
that.
But the reason is this, and because it comes down to this plan would be governed by the regulations governing deferred comp 457F, and there's a worry that if you provide too much discretion, it may result in a violation of what they call substantial risk of forfeiture, and the amounts would have to be paid up front. So that is the reason why it's not in there.
Okay, but no, I'm not in favor of the discretion, so I just wanted to validate that there wasn't any there.
That's right. And we wanted to make this as simple as possible because we know that despite its complexities, we don't need anything too complicated. CalPERS is a very, complicated organization with a lot of moving parts. We wanted to make this as simple as possible, specifically for Mr. Miller's concept, which is rallying the troops around overall group performance. So.
Okay, thank you.
And Mr. Jones.
Yeah, thank you, Madam Chair. Identifying all of the issues surrounding the threshold being at 6.5 that have been raised by my colleagues, would most of those concerns go away if the threshold is 7%, which is our discount rate?
They do go away, except to the extent if that 7% is unrealistic. Folks would argue that by not paying out.
You say unrealistic to what? That is our discount rate.
Right. Is if it comes down to the sustainability. If 7% is a stretch, then is that truly outstanding performance, or is it good performance? There's an issue that I will say that generally the issues go away. It's just a matter of 7% is an appropriate target or even a threshold if it is a realistic.
Well, I guess I would have a problem with that comment, because if our whole sustainability of our fund is based on this 7% achievement goal, and if we're saying that now it's not good enough for an incentive award, then that doesn't work for me in terms of that comment about it's not realistic or it's.
No, my point was that if it is realistic, I think it's a great target or even a great threshold. It just has to be realistic.
And then I think someone also mentioned that the discount rate could change in the future. Mm-hmm. Your threshold would change with the discount rate change going forward, right?
Absolutely.
And so all these other pieces would kind of go away because and as Mr. Junkins indicated, that the strike point in private enterprise where you don't get that until you get the returns that are designated to be a profitable company, and then you start participating in it. So our discount rate is what we need to be sustainable, so you should be rewarded if you go hit that or go above it, not below it, I don't believe.
Yeah, no question. And again, it just comes down to achievability. And if we can settle on the fact that the 7% is a very realistic expectation, then absolutely, I'd agree with you 100%.
And I will say that I think that Mr. Miller's conversation about culture, if we're going to meet a 7% rate, right, and that's part of the incentive, I think that's part of our culture then, and that's how that gets communicated, et cetera. But Mr. Perez, you're next. Oops, wait, do it again. My bad.
I'm
I need you to click your,
There you go. You got it.
there. Thank you.
I haven't been tracking all of this. Am I understanding correctly where it's a total fund, not just a certain area?
That's correct.
In my pea brain, it makes more sense to have, the real estate guy tied to the real estate performance, the widget guy tied to the widget performance.
We have widgets?
Yeah. But I'm sure you have a reason why that's a bad idea.
Yeah, it certainly isn't unheard of to incentivize folks with their specific asset class, et cetera. But the point here is to encourage a level of overall group performance. Kind of that groupthink mentality. And a long-term incentive plan in just about any industry does tend to be driven more by overall organizational performance. Because again, what does it do? You have the annual incentive plan that has certainly some organizational components, some individual components, versus the long-term incentive plan, which is intended to encourage all of the senior players to come together in terms of making sure that you satisfy your fiduciary duty. So it encourages an overall perspective on performance to balance with the inherent individual nature of things like salary increases or some annual incentive components.
Well, I'm thinking under the assumption that we're hiring the professionals that we're always going to do that. We're always going to put the fund first. But the widget guy shouldn't be held back by the doohickey guy.
So maybe I can take this one. So the former or the current incentive plans prior to July 1 really were incenting at the asset class level. So the real estate guy versus the global equity person, right, et cetera, private equity, all separately incented based on their asset class. What Ben is trying to do within the investment office and creating this culture to the total fund is to incent people to the total fund for any additional payout beyond their base pay. So part of the July offsite session with Ben, he will be walking through his 180-day plan, his workforce plan, and why incenting to the total fund is what he's trying to create within the culture of the investment office. So we're moving out of what you described as the doohickey and
the
widget maker into we want everyone working to the total fund, because the way that the entire portfolio can be successful is if you have all of the investors working together to make sure that that 7% return target can be hit. Otherwise, what we found is that there is too much siloed thinking and not across asset class thinking. And so we had potentially investment decisions canceling out investment decisions in other asset classes because there wasn't that total fund thinking. So this is something Ben is bringing in. I know the team had been working on this prior to Ben coming in, but Ben is really reinforcing it and getting it moving through pretty quickly and then tying it to the incentive plans, including the annual plan.
So we tried it and it didn't work.
It doesn't work to the culture that we're trying to create over there.
So what's the gap, sir, then if we're trying to make it, excuse me, if we're trying to make it more attractive and to bring people in and then retain the good folks that we have, what's the gap between, top step widget guy and industry standard widget guy? Basically, why don't we just give them a raise instead of incentives, so we don't have to tie it to this and that and the other thing?
I think
why don't we?
that
I mean,
too.
you get what you pay for.
So they get that too.
Yeah, they do. As part of the salary increase component, there's an ability to, make because your salaries, if you're never going to pay absolutely competitive with what goes on in industry, and so the salaries are a key component, and so. Those have been benchmarked, and they're set at market levels from a salary perspective. And, one's individual performance will be contemplated as part of that. The other thing is that when you think about both the annual and the long-term incentive plan, there's always an incentive to focus in on your own individual responsibilities, because if they're not up to par, if they're not up to snuff, you do not get to participate in either the annual or the long-term incentive plan. So.
Does that make sense?
Maybe I can follow up on that, Doug Hoffner, CalPERS team. So in February, the committee and the board ratified the elongation of the salary ranges that exist based upon the data that was provided. So that's going to give a longer runway for individuals to move through those salary ranges. So that's not like a guaranteed, pay increase by any means, but based on performance and how they perform over time to meeting to Ben's plan of this total fund, we've given them a longer runway you have. And then this is an additive piece to that as well from an incentive perspective that we haven't had historically. So they're sort of all additive pieces. And then what does that look like when they're put together over time? And what does that performance look like? Because that's really what we're striving for. If we're not performing, we shouldn't get paid. That's sort of the mentality we're talking about.
Notwithstanding optics or external pressures, I really believe you get what you pay for.
All right, thank you. I want to remind everybody that this is a information item. We will be discussing more of this as we move into the July offsite because Ben has his presentation. And with that, I'm going to call on Mr. Miller.
Okay, I'll keep it really short. I think to some extent the challenge is it's a little bit of semantics. It's when we say long-term incentive, we're not talking 30-year long-term, but we seem to be applying that really tough lift that Ben's talking about that is way beyond kind of even the expectation of cycles of longevity and tenure in these kind of positions here or elsewhere. And so the idea of maybe using something other than that 30-year target for the long-term incentives on a kind of a moving along basis, and those 5-year resets would make more sense to me.
Okay, and I have no more questions.
Ms. Taylor,
thank you, Mr. Junkin.
Sorry.
That's okay.
I wanted to tie together a couple of things that I think were sort of thematic in Mr. Jones' comments and Mr. Perez's comments and Mr. Miller's comments. Wilshire has had a large role in incentive compensation since incentive compensation began at CalPERS, including the calculation of the factors that are used to pay out people based on performance relative to benchmarks and things like that. And I think the changes over time within the organization and within the compensation structure have been aligned. And so to the point that Ms. Frost made, there's been a 10-year effort within this organization to remove silos, to break down the silos, so that there's knowledge sharing across all of the asset classes, which I'll just be honest and say 15 years ago, well, I started 14 years ago. 14 years ago, it didn't really exist.
Right.
You know, fixed income thought about fixed income because that drove 100% of their incentive compensation plan. And that's not to pick on them. The same would be true of any asset class. So adding a total fund component came about a few years back. It's been increasing in weight. There's been some discussions for a number of years about moving to 100% total fund, and that's really the direction that you're headed here. So having gone through my own compensation issues at Wilshire, being very sensitive to culture, I really feel like you all are headed down the right path in continuing to break down the walls, because you think about 2008, which is something we all want to protect against, right? There was damage in real estate, there was damage in fixed income, there was obvious damage in equity, but there were also ways to work together to protect the fund that crossed all of those asset classes. I also want to kind of go back to the 7%, because I'm not sure I gave a great answer, because I sort of was thinking through it as we went along, and some of your comments clarified my own thoughts. You know, this is brand new, right? You haven't had a long-term incentive plan, so you are setting the precedent here. And so I think setting the precedent and saying we're aligning the long-term plan with the long-term goals of CalPERS would argue for that 7% goal. And even if the 10-year number, the 10-year expected return is a little bit different than that, it's not 25%. You're not setting the payout at 25%, which is so unrealistic that it would demotivate people, if that's a word. So I think, you know, from a precedent-setting standpoint, you're just saying we're all in this together, right? Your goals and our goals are tied together. So I just felt like sort of, I think the fact that what you do this time around will echo for a number of years was an important point.
Thank you, Mr. Junkin. I did have a question for you. When you are doing Wilshire's performance compensation, is it typical in the industry to be siloed, or is that a state issue?
No, I can comment very specifically about Wilshire. Wilshire has 4 different business units. There is some siloing that goes on, and we are working to tear that down just like you are here, because we recognize as an organization there's a lot of intellectual capital within the firm that we want everyone to benefit from.
Right.
And so that's, I think, industry-wide, that is exactly what you're seeing.
Okay.
That it's not an eat what you kill industry as much as it used to be.
I see.
And I think that's a technical
not
performance term.
I would just follow up with that to say, I mean, that was one of the outcomes. We've all read the reports, and both Eric and myself, we consult a number of financial services companies, and there has been a strong movement towards specifically organizationally based long-term incentives. The whole issue is to causation, right? I mean, but what came out of one of the reports was simply that below that senior executive level, the folks that were managing the money on a day-to-day basis, they had so much incentive based on their own individual performance that they were placing risky bets because they were going for that bet to the collateralized debt obligations, et cetera, just to bring in the deals by the end of the year. And it was so short-term focused, but they had a lot of money on the line. But because it was so individually focused and because it was so short-term focused, there was an argument that helped to contribute to the collapse. Now, it's not everything, but
Right.
it certainly is a factor that folks are trying to avoid. So.
All right, I appreciate it. Anybody else? So we are now on 8C, which is summary of committee direction. Did we have something, Mr. Hawk?
I didn't hear any specifics other than I think we would take back through Grant Thornton's work to look at those thresholds and targets and those things to come back with a different set of parameters based upon the feedback. While it wasn't committee direction, I got a very strong sense of what I think the group was looking for from the next round.
Yeah.
I think the only question I have is there any other data analysis, information, or feedback that you would like to have the consultants incorporate so when they're back before you in August, so if there's anything that comes to mind, I think that would be an opportunity to give them anything else that we haven't heard already today.
So, wouldn't our CIO's workforce plan have some impact on that?
Yes, I just thought from the committee's perspective, you won't hear that for another month.
We won't hear that for
so
another
it's just in the intervening time period. But
I can't think of anything. Does anybody have anything to add? I think we're at this 7% is our bottom. And we're trying to create a culture. So I think that's it.
No, and we would be comfortable. I mean, the 7%, and there's always things to work through, but we were well aware. I mean, what we wanted to do is demonstrate how this could potentially work. If the 7% is where you end up, I mean, it certainly is. It sounds reasonable.
Okay, great. All right, and then 8D is public comment. I don't have anything else? Did I miss anything? All right. So if that's the case, then the Performance Talent Compensation Talent Management Committee meeting is adjourned at 4:14. And when do we start tomorrow?
9 o'clock.
And we are starting at 9 a.m. tomorrow.
With board governance.